Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name's Corey Kramer. Today, we are going to be doing a little case study on Walgreens. It was announced today that they're going to go private in approximately a $10 billion deal with Sycamore Partners. And I wanted to share some lessons that investors can learn and also why I don't invest in turnaround stocks. This is a really good example. So as always, this is not individual investing advice. This is just how I analyze stocks. Now, the idea of doing a video like this is not specifically to go back and talk about Walgreens, but to learn what not to do as an investor if you want to make money. Basically, to learn how to not lose money as much, because there were some pretty clear signs that this wasn't a good investment for people. So that's the announcement. Let me pull up the fast graph real quick here. I do have a 25% off affiliate link down in the description for fast graphs. If you want to check it out, they have free trials over there. Okay, it's good for illustrating things like I'm going to illustrate here. All right, so I first started writing about investing 10 years ago, almost 10 years ago. It was third quarter of 2015. So we're in 2025 now. And back then on Seeking Alpha, there were a lot of dividend growth investors. There still are a lot of dividend growth investors. But that was really kind of a hub of them back in the day. And before we got AI and some of the other things that we have going on, because bond yields were so low, dividend growth investing and dividend investing became really popular, which made sense, actually. I said I was going to make a video about dividend growth investing, and I am. It's coming soon. This isn't going to be it, but I went back and looked because I was curious since over the past 10 years when I started writing, because I remembered so many of these articles, and my memory served me correctly. There are literally over 100 or 200 buy and strong buy rated articles on Walgreens during this period from around the peak of the decline in 2015, or peak of the stock price in 2015, all the way through today. So the question is, and these guys are dealing with stocks every day. They don't have to write buy articles. They could have not written an article or written on something else. And the question is, how can so many people make these mistakes, right, for so long? Now, I made a video. I never bought Walgreens, but I did make a video about why I avoided buying it. I think it was, actually, I wrote it down here, November 13th, 2023. You can search for it. It's still on the channel. I say a lot, which I'm trying not to do as much anymore. So we have, like, even since then, so yeah, the price was like $20 a share. And I was just talking about why I avoided it. And I made other videos about why I don't buy turnarounds, but we see that even since then, it's down 50%, right? So a person could have looked at it back then. I'll just roughly pick here. It was down 65% off its highs and say, well, they're a dividend aristocrat, a dividend champion. They've been around since 1927, right? It's down 65%. The PE was like a 6. And there are people who think, hey, that's probably a pretty decent deal. And I was basically explaining why I didn't think it was a decent deal. So this is why. Because it falls another 50%, and now they're getting bought out. So everybody that's bought this stock that didn't buy it in the past 2 months, even then, I mean, you're only getting a 20% gain. It lost money on it, basically, if they held it over the medium term. So what could you have done to avoid this? Well, one, this is a reason to not avoid, or to avoid turnaround stocks, because you don't know if the turnaround's going to come. Not only if you bought up here did you lose money, but you also could have waited a long time for this to turn around, and then the stock price falls, and then they just get taken private, right? And have no doubt that eventually they will come back public again. There'll be a bunch of hype around it, and they'll suck investors. and probably a lot of investors won't even know. There'll be somebody managing their money, and they'll buy the new IPO spinoff or whatever kind of garbage that they bring back to the market. So it's just kind of a game that way. But and all the people that go on Bloomberg talking about dividends and how safe healthcare stocks are and I mean, they all just got taken out basically. So how could you avoid this? Let me get to this. So other than just avoiding the turnarounds, up here it wasn't necessarily a turnaround yet. One of the main things to watch for, well, at the beginning, here's kind of what to watch for. You want to watch for M&A, big M&A. So in, let's see, 2012 to 2014, so they probably announced in 2012, closed in 2014. They had a $6.4 billion merger with Alliance, right? That's where Alliance comes from, from the Walgreens Boots Alliance. So that would have been back here. You can kind of see growth was a little bit, I mean, it was still okay. It wasn't bad, but the stock price had been kind of stagnating a little bit. And then things got really good for a little while, which is usually what happens. You have a bunch of, goodwill and things, all the sort of synergies that you're supposed to get over time from your wonderful merger. And the stock market loves it, and it rockets up to 25 PE. And I wonder what the basic earnings look like here. Let's take a look. So this is what it really looked like, right? Earnings down, down, down. They had one good year, basically, and then after that, flat again, going nowhere. But the market loved it. And then what they did was about the time things start looking a little scary, not as good as everybody expected, then they bought Rite Aid. So the Rite Aid was for $9.4 billion. Now they're getting bought for $10 billion. That was in 2015, so 10 years ago. And so we can see how that turned out. But it takes a couple years usually for that to happen. And I have a rule. My rule used to be 3 years if there's big M&A relative to the value of the company. Usually if it's more than 20% of the value of the company, like the company that's being acquired, then usually 9 times out of 10 or 8 times out of 10, that doesn't work out very well. It might initially, but once they start writing off things and reality sets in a few years later, then the stock price gets hit. Well, instead of that happening for these guys, they just they did it again, which happens. And the reason, this is just my opinion, obviously, but the reason for that is that usually the revenue number is what I watch, the 3-year revenue. And when that starts to go negative, and it's not a recession, like there wasn't a recession during this time period, when revenue this year is lower than it was 3 years ago, that's my sign usually to sell, and it's a sign to avoid. If it's a mature big company and there's nothing else that it really explains it, because that's a sign of eventual earnings and decline and competition or changing consumer tastes. But these companies know this, and these CEOs know this, and so they want to keep their jobs, and so they just legitimately think that they can grow the company. It's easy to fool yourself sometimes rather than just like accepting kind of the way things are. And so if you go out and buy another company, then your revenue goes up, right? And then you use kind of accounting shenanigans to make your earnings kind of look like they're going up too. And they might actually be going up. It just depends. But the main thing is, the clearest thing to watch for is that about 3-year revenue, if it's not a recession or COVID or something like that explains it. But that gets clouded if they're buying other companies. So my policy is if I see them buying a bunch of, or making a significant purchase of another company, I just don't buy it. So I used to have a 3-year rule. Now it's a 4-year rule because, they can just stretch it for a long time before the market kind of finally catches on. Investors kind of stay in denial a long time sometimes with stuff like this. And it takes a long time to play out. This is a 10-year decline. So, and lots of people would have bought along the way. Now, the 3-year revenue number almost went negative going into COVID. So 2020 was about the first sign it was barely positive. That's even after these acquisitions were made. I don't know what it would have been without them. But once we get into here, now you have a COVID excuse year, like a reasoning, right? Obviously. But once we got 1 or 2 years out, then, and they didn't recover, then you know, probably not so good. And earnings trajectory is down, and the price is down. And so when you start to ask yourself in here, like in 2023, when I made the video, you could look and see this is a company that is on the decline. Like everything was kind of mostly in the open. Some companies can turn things around. It's very hard to do. And even when it's successful, you don't know how long it's going to take, and you don't know where it's ultimately going to bottom at. So in this case, it bottomed at half of what it was when I made the video, and like, I don't know, 85% lower than, what did I say earlier? Almost 90. We'll call it 90% lower than the peak. This is a well-known brand name store that has been around for over 100, or not over 100 years, almost 100 years. So 98 years. All that history doesn't matter. The dividend streaks don't matter. If you waited to sell when they cut the dividend right here, you're down like 80%. And if you bought it back here, you would have wasted, 15 years of your life holding this stock. So, but that doesn't mean that there aren't real turnarounds sometimes. They do happen. It's just one of those things where, I know I'm not good enough and have enough insight to get both the success of the turnaround picked correctly and the timing of the turnaround picked good enough to make money in time. Because time is an important factor here as well. I mean, when you compare what would have happened here compared to if you just like bought the S&P 500 or something, I mean, the S&P 500 is up like probably 200% over the time period. So the opportunity cost is even worse than losing 90%. You're like in the thousands of percent. So I think that's my word of caution. Watch for the big M&A, especially if you can see that growth is going down. And because that hides the revenue. You want to watch the revenue first, but keep an eye out to make sure that they're not inflating the revenue number. They can also inflate the earnings by buying back shares and doing all the things that I normally talk about too. They can also take on more debt, right? Sometimes instead of buying a company, they'll borrow money and buy back their shares so their earnings per share go up, and they'll borrow money and pay a dividend so their dividend streak keeps going. So there's lots of different ways that these companies try to, hold out and pray for better days or something, if I'm being generous. So yeah, just this is why I don't buy them, and hopefully that's a lesson everybody can learn. I'm going to put this in I think I have a playlist that are case studies for investors or new investors. I'm going to put this one in there. It's kind of a classic where the worst happens, and it will be a little bit looking forward to the future, because someday you're going to see this Walgreens assets or whatever come back on the market, and you're going to say, and everybody on the news media is going to be going crazy about it, and you're going to be smart enough not to buy it. So, because they're just trying to unload it on you. All right. Enough of me today. If you found this useful, hit the like and subscribe button. I have a free tier over on Patreon where I post these videos as well. I also have weekly picks over on Patreon for $25 a month. Go check those out, and the links are in the description. I'll see everybody later. Bye.